Now today we're talking about a strategy that I love, and this is a put selling strategy that I employ instead of buying stock. Now, as you guys know, I'm a long-time dividend investor. I don't often do swing trades, and I definitely am not a day trader, so to speak. I sometimes put on option trades that are held for a very, very short interval, but more normally I'm trading over a couple week period. So I put on a trade, and then I let that trade kind of stay within a range, and that's where I make most of my money as an option premium seller. So today what I'm going to do is I'm going to show you the details of this particular trade. Now it's going to be on Etsy. For those of you who don't know, I have an Etsy store. It's one of the reasons why I love trading that particular stock, because I like to buy things that I use. It's one of my personal rules of investing. Invest in what we use. So if you guys don't know my personal rules of investing, you should definitely check them out. I've got a video specific on that. It's on the homepage. If you're new to the channel, you should definitely check out my rules, because it's kind of what allowed me to build my wealth over time and become a 40-year-old retiree. All right, everyone, welcome back to Drawbridge Finance. My name is Levi Woods. As you know, I'm not a professional investor. I don't work in the finance industry, and this is an opinion channel about money. It's happy Monday. It's amazing. We had that huge sell-off last week. I'm making this video way before market open. I'm still in Tokyo, so it's daytime here. The market doesn't open until 11:30 tonight for me, and I'm chomping at the bit to get some trading in. I don't know if there's going to be any trades being placed at all. We're looking at the futures market. We'll be looking at the pre-market prior to opening, and I hope that there's some volatility compression and that the VIX comes down to a level where we can actually put on a trade this week. Right now, today, what I'm going to do is I'm going to talk through a trade that kind of went a little bit south on me, and how I managed it and how it was able to recover and become a profitable trade, because I think that this is important, especially in a time like this where there is a lot of volatility, and this trade shows it off very, very well. We're going to look at a 1-year chart on Etsy, and I'll show you my mindset, because I trade this pretty regularly. I want to make a option premium trade, ideally every single month. And now that's not realistic. Somebody asked me today if there was no fees for option trading, would I trade them every day? Well, I do trade options very, very frequently. I usually put on anywhere between 20 and 30 option trades a month. So that's more than daily. And I still pay fees. I'm Canadian. We have ridiculously high fees comparatively to my American counterparts. So if you guys are in America and you're thinking about getting into option trades, if you have a large enough account to actually make it worthwhile, the fact that you have no option fees for trading them, or very, very low, makes them ideal, especially in the strategy that I'm showing today. Now, I said before, I'm an Etsy holder. I have an Etsy store, but I own the stock outright. And what I like to do is I like to look for entry points where I can add to my current position, because by owning the stock, I am bullish on the stock. I believe that the company is good and it has a good value and it is going to increase over time. So when I'm looking to pick up stock, I want to buy it at an appropriate level. I want to buy it low so I can sell it high later. I mean, that's kind of the whole idea with stock trading in general. So if we look back at the 1-year chart, I'll show you a couple trades that were leading up to the specific trade that we're looking at. I made a little trade in here. This was in July, and I held it for about 3 weeks, and we made a small profit there, and that was pretty nice. Now, if you guys are interested in looking at any of these, you can go back and look on my Patreon page. If you go to posts, there's a brand new search bar. So you can just put in Etsy right here, and it'll just pull up any articles or posts that I've written about Etsy, which is amazing. Or you can do it by keyword. So if you just go to these tags, you could look through here and find the one on Etsy. You can see I've got 24 posts on Etsy over the last 3 years. I've just typed in the search bar Etsy and showing posts with Etsy in it, and we're just gonna scroll down through and take a look. As I showed you on the chart, I had done a trade in July that I held for a little bit longer, and then I had this quick little trade in October. I held it literally for 2 days. I put on the position, it was bullish, the stock just drove straight up for 2 days, and I was able to close the position. So here's the September 20th, closing the Etsy options, 17% gain, that's 112% annually. And then October 8th, I put on new Etsy's options. I gave a few details about what the trade was. Just like I said, stock market is down, so it's a good day to sell puts. Short-term play, make a couple of bucks. 86% chance of the stock staying above $50. If we look at the chart back on October 8th, at that $55 mark, it was trading just under that 20-day moving average, and I wanted to get it for an even better price. So we had a couple of down days, and we were expecting a few up days after that. You know, this is just like how the cycles of a stock move. That one we closed for quite a nice gain. It was a 250% annual gain, but basically we sold originally for 40 cents and then we bought back for 15 cents in just 2 days. So that's a nice little profit. The one I really want to talk about is this one, October 18th. Trading kind of down and then up and down, and it was just trading in this trough. I was expecting a little bit of a rally to up until earnings. I thought, well, the earnings are coming out in 2 weeks. And I said that right in the post. Opening, selling a short November 15th, 50 puts. $50 is what I want to pay for the stock. That's how much I feel. You know, this is my personal threshold of what I want to buy the stock at. It's trading at 55. I would like to pay 50. You know, that's exactly what we would all want, is be able to buy the stock for less than it's currently trading. Wouldn't that be the right thought process? So that's what I want. So the stock price that day was $58.76. The earnings are expected November 6th, and I want to have this trade closed before then. This is a quick bull trade, as I am expecting upside movement next week. So right there, looking at that chart, we had this down day and that we were going to just charge up here. I was going to be able to collect that premium. The same way I had just done on October 10th, where the market was just going to drive up and I was going to make a nice little tidy profit in a really short time frame. I did not want to play through earnings. Now, my mistake with this trade was actually that I was wrong. If we look at the post, I said that earnings were November 6th. Now, I don't know if they changed the earning dates or if I just looked at a bad announcement, but this is why everybody should always do their own research on every trade. You know, you should never be following blindly anyone's trades, but this was a blatant mistake. The earnings were actually October 30th, and I ended up getting caught in that, and the earnings came out and the stock dropped down, and I was unprepared for that. I was expecting to close the trade prior to earnings, which I completely missed. You know, my bad, it happens. So let's look at what I was looking at that day. Now, I was looking to sell the put, and I was going to collect $1.10 US dollars. We've got a little trading log here, and we're just gonna go over to that, and I'll show you the first line. So this is Etsy put option profits. So the date was October 18th, the stock price was $58.76, and I sold, so I'm short, one option. The option was $1.10. So I collected $1.10 on that day. There's 28 days to expiration, sell to open, puts, November 15th, $50. So these are the November 15th, 50 puts that will expire 28 days from October 18th. If the stock is above 50 bucks, those options will expire worthless. I sold them for $1.10 on October 18th. So the point of this is that I'm hoping the stock will rise up further than the current level of $58.76. This option price will decrease because of that upward movement, and I will be able to buy it back. And you know, on a trade like this, I might expect to buy it back for 85 cents or 90 cents and make a 20 cents difference. Now, each options contract controls 100 shares. So this $1.10 is $110. So when I say $1.10, I actually mean 110. And when I buy back for 85 or 90, then I would be buying back for 85 or $90 and collect that difference in a couple of days. So that was my intent. Now, what actually happened with the stock was, as I said before, I got caught by earnings. The earnings came out and the stock dropped. It gapped down, which is the absolute worst thing that could happen in my position. My position makes money when the stock goes up, not when it goes down. And it went down far enough that it went past my strike price. My strike price was here at $50, and the stock was all of a sudden trading at like $44. And I kind of was like, oh, shoot, that's not what I wanted to happen. My option is going to expire on November 15th, and I have to do something about it. So I watched the stock, and it's kind of waffling for these couple of days. It's not doing much. So on November 5th, I make a trade. And what I do is I just roll the option out. I take my November 15th expiry, I buy it back for a loss, and then I sell the December 50 put. Let's just look at what that looks like. So the stock was trading at 44.98. Buy to roll puts, November 15th, 50. Positive 1 contract to negate my original sold contract. So now I've got 0 after this transaction. But it cost me $5.12 to do that. I originally sold it for $1.10, buying it back for $5.12. That is a major loss if I stopped there. And there's 11 days left in the trade, and this is exactly why I'm closing it. When the option becomes in the money, there's risk of assignment. So I want to give myself more time so that there's less risk of assignment. So that's what I did. I'm rolling out 1 month in time. So I sold to roll puts December 20th for $50. So the only thing that's changed is I've given myself an extra 35 days to be correct about my assumption. And for that roll, I was able to sell the December contract for $5.72. So I'm short 1 December, collected $5.72. Now the difference is 60 cents, the difference between $5.12 and $5.72. Now I have 46 days for it to go back up above 50 bucks. So here we are, November 5th, and the stock continues to drive lower. Again, not what I wanted to see at all. But we start to see a rally. Buyers start to realize that there's some value in the stock, so they start to put out their money and buy some stock. Here it comes up. And now we're getting into this range where we're coming up on Christmas. There's only 20-something days left in the trade. There was 21 days left in the trade, which is kind of my optimal. The 3 Fridays before option expiration, that's when I want to get out of that trade. 21 days left. So right on the money, that's when I did it. November 29th, I did the exact same thing. I'm going to buy back the option for a loss, and then I'm going to sell the option again. So this time there wasn't as much drop. The stock was trading for only $1.50 lower. The original trade that I sold for $5.72 this December, I was actually able to buy back for $6.57. Only a 75 cents difference. Still driving this lower. But because I'm rolling out in time, and my assumption is that the stock is worth more than $50, then I believe that the stock is going to continue to go up. That was why I put this position on in the first place. I want to buy the stock for 50 bucks, and it's okay if I do. I'm just collecting a little bit of credit as I go along. So in this case, I'm buying back the December 20th. I'm rolling out to January 17th to give myself some extra time, in this case 28 more days, and I collect the difference between the purchase price of buying the puts and the selling price of selling the new January puts. And I collect another 30 cents. Not a huge credit, but still another 30 bucks into my coffers. And again, my assumption is that the stock is going to come up. Again, the stock drove down. Not very happy about this at all, but we continue to start seeing a little bit of a rise. And when we get down to the end of December, December 31st, it's the end of the year. There's not a lot of trading in that week usually, and I'm going to roll out in time. So this time what I did was I decided to give myself much more time. Instead of putting on this trade every single month and saying, okay, I'm making the transaction and I've got this in the money put and I'm just concerned about it, I'm giving myself more duration, more time for Etsy stock to recover. So that's what I did. December 31st, the stock was trading at $44.30, actually an increase of almost $1 from the prior trade. Did the same trade again. I bought back the January puts, and this time I sold the March puts. By selling further out in time, I was able to collect way more credit. So I bought back a position for $5.41 that I had originally sold for $6.88. So there was a bit of profit there. And then I sold the new put in March for $7.36, this time collecting credit again. So I've collected credit 4 times on this trade, $1.10, 60 cents, 30 cents, and now $1.95. And now I've got 80 days for that stock to come back up into that $50 or above range. Let's look at the chart and what happened. Well, this year, as we know, was having an incredible upswing. Everything was doing extremely well. So the stock finally started to get some traction and we went up and up and up, 51.5, and then it started to flatten out and come back down. I continued to hold because I want to sell and get the most premium that I can. And ultimately, I've got time left at this point. We're at the beginning of February, and I believe that the stock is going to go up in value higher. It should be over $55. I mean, it's been trading in an upward range for a very long time, and I trade this every month, so I know. So here it goes. Now it starts to really break out, and we go up. There's still a month left in my option contract, and the stock broke the $55 mark. Still wasn't quite a small enough premium for me to buy out for a large profit. And again, I don't care about this. I'm just going to keep doing it over and over. These are small positions for me, and I can just roll them each and every month and collect a credit if I need to. I was hopeful it was going to continue to go up, and it didn't. It went down a little bit, went back down to $50. And then the earnings came out, and again, I'm just trading right through earnings at this point. I don't really care about it, because if I buy for $50, I'm totally happy buying it. And of course, earnings came out and the stock jumped way up to 57, which is way more appropriate range, where it's trading now at $57. Now, the reason I wanted to make this particular video is because these are stocks that are performing extremely well, even when the market was tanking last week. The Etsy earnings and this gap up actually happened in the middle of the week last week. So there are stocks out there that are having up moves that are not actually going down in this down market. So finally, I got to close out the trade for a debit. So if we just take a look, the stock was trading at 57.81, February 28th, which was just last Friday. I finally closed the last contract. I paid 75 cents. So now the total, if we look at this, collected $1.10, 60 cents, 30 cents, $1.95, and then debit of 75 cents. So a total credit of $3.20. So now I want to just calculate the profit so we can look at the annual return. Now I'll run this through for you guys so that you understand how to calculate annual profit, which is calculated by the premium received minus the fees. Now I said before, I still have large fees in Canada, so I have to count those in. That equals my profit. So here's an example. 320 was the total credit, or times by 100. That's because it's one contract, controls 100 shares. So that's $320. And then minus, and we'll say in this one, there was a total of 8 trades and each trade costs $1.25. I think that's probably pretty average for a lot of people down in the States. If we look at how many trades there was 1, 2, 3, 4, 5, 6, 7, 8 trades, $1.25 times 8, and then we'll get our profit. So 320 minus 10 equals 310 in profit. Now to calculate that percentage-wise, we can tell how much percentage gain. It's just the profit divided by the margin required and then times by 100. That gives you your calculated return on investment in percentage. So in this case, it would be $310. Now the initial margin, that's the amount of cash that is required to have, you need to have in your account to put on this trade, was $750. And then times by 100. So 310 divided by 750 times by 100, and the calculated return on investment is 41.3%. I also like to calculate it annually, so that's easy enough to calculate it annually. We take the return on investment, we divide it by the number of days held, and then we times it by 365. So 41.3%, and then divided by 134 days, that's October 18th to February 28th. Then we times that by 365, and we get this total 112% return. So that's the calculation, so that if we did this trade every single day for the entire year, which we're not expecting to, there's always going to be gaps. We're always looking for the opportunity, then we close when the numbers are right, and then we wait until the next opportunity. So we have to play a multitude of different stocks and different options in order to be able to make money off of a strategy like this. But if we did it every day, our theoretical return would be 112% on a trade like this. Now, this is super complex, and I know there's going to be terminology in this video that was way over people's heads, but I assure you, when you start to think about the buying stock and the risk that you're taking buying a stock compared to selling a put and the risk that you're taking by selling the put, there is a mathematical advantage to selling the put by itself. Now, there's a disadvantage, of course, if the stock goes up too much, then we're missing out on profits. Now I have a chart that I've been working on for quite a long time, this spreadsheet, and it's actually available to my March patrons. So anybody that is a patron on my $7 or above tier on Patreon is available to download this chart. I'm just doing some final tweaks on it today just to make sure it's absolutely glitch free before I post it. But anybody that is a patron for March will be able to download it on my Patreon page, on the post page, and it actually says 0 on the digital files, but once I upload that, it will be available to everyone. And if you don't want to become a patron, that's cool as well. You can go and purchase any of my spreadsheets on my Etsy store, and that's why we're doing Etsy today, because I actually use Etsy and love it. It's a great product, a great website. This is not a sponsored video, by the way. It's just I'm a shareholder in them and I love it. Anyways, I think that's it for today. I hope that what you guys learned something, about option trading and that it makes it a little bit more clear. If you have any questions, please leave them below. Check out some of my other videos so we can all get rich together. Thanks so much for watching and see you very soon.